True Stories of Investing está patrocinado por DEGIRO.
Investing. That's what people with money do, right? People who like to take risks. People that know when...
True Stories of Investing é patrocinado pela DEGIRO.
Traders or Wall Street brokers to be successful in the stock market. And that with some basic guidelines, anybody can be a smart investor. In this documentary, we challenge some of the biggest misconceptions about investing by looking at true stories. And in the process, we teach you some of the basic ideas that every investor should know. In this documentary, we discuss one of the key principles we need to understand when we start investing: the difference between active investing and passive investing, the great boring alternative. While one relies on speculating and trying to beat the market, the other is focused on the long term and on slow and steady growth. Everybody knows the saying, don't put all of your eggs in one basket. We'll look at what that means for investors, as well as how to stick to your plan and not get carried away by hypes and bubbles and by scary stock market crashes.
Well, the law of gravity hit Wall Street.
We'll see that investing is not only about making money, but that it can also be about making a positive impact towards a better future. Let's start off by learning from the best, one of the most successful investors in the world. They call him the Oracle of Omaha, Warren Buffett.
He bought companies that he thought weren't especially exciting, but were likely to generate decent returns over time because the companies were well run.
A boring but deliberate strategy, one that has clearly brought him his success. And he doesn't mind pointing this out to Wall Street.
Warren Buffett, the billionaire investor, made a friendly bet against hedge funds, and the winner will get $1 million to donate to charity.
So in 2007, he decided to issue a bet. I invite a hedge fund manager to come up and give me a bunch of hedge funds. And I'm going to propose a passive strategy involving no work over a 10-year period. And I think my passive strategy will beat the best hedge fund managers put out there.
To win the bet, Buffett picked the most unspectacular kind of investment around, an index fund. We'll get into that later. First, let's have a look at who he bet against. Enter Ted Seides, a fund manager with an active investment strategy.
There are two kinds of investing, active and passive. So an investor who invests actively, they're really looking around for stocks especially that are undervalued, and they want to buy those stocks before the rest of the investing world figures out that the stock is undervalued. You buy low and you sell high, and the difference between the low price and the high price is big.
Active traders like Seides try to beat the market. Whether the market is going up or down, it means trying to be one step ahead of all the other investors out there. The dedicated active investor can be quite successful, and this strategy can really pay off. Some active investors try to beat the market in the most elaborate ways. This gentleman even used satellite imagery of department store parking lots to get some insights. The more cars in the lot, the better the store must be doing, so the more stocks he bought. Trying to beat the market is a strategy most of us can't afford, though. It takes a lot of expertise, time, and money. Most of us can't afford to rent a satellite. Considering all this, the world of investing might seem intimidating to enter, but it doesn't have to be.
Ik ben eigenlijk geïnteresseerd geraakt in beleggen op het moment dat ik mijn bedrijf verkocht. Toen had ik wat vermogen. Ja, dan wil je graag wel aan het werk zetten. Je wil in ieder geval niet op een spaarrekening zetten. Ook voor gedeelte voor pensioen, omdat ik ondernemer ben. Dan ben ik eigenlijk de wereld ingedoken van vermogen, iets meer vermogen. Dus toen kom je vermogensbeheerder terecht, banken. Dat is eigenlijk de basis geweest van de podcast.
Ja, ik merkte in mijn omgeving ook al wel dat er wat interesse was voor ja, wat moet ik nou met mijn geld? Rente is... Er is nul, ja, er is nul rente. Dus ja, wat moet je met je geld dat je op je spaarrekening hebt? Dus ik dacht, ja, volgens mij willen mensen dat wel leren. Dus als jij gaat beginnen met beleggen, is het misschien wel een idee om mensen op die reis helemaal mee te nemen, van begin af aan. En ik weet er ook nog echt niks van. Ik dacht, ja, het is toch ingewikkeld. Waar moet je beginnen? Moet ik precies weten wanneer ik moet instappen in een bedrijf? Moet ik precies weten wanneer ik moet uitstappen? Dan moet ik dat bedrijf tot in de kern snappen. Maar toen ik begreep dat het ook op een andere manier kon, toen dacht ik, nou, waarom zou ik het niet doen?
A passive investor is not so much interested in picking stocks that are undervalued and holding them, but rather buying them and simply waiting for them to naturally appreciate. Passive really means buying and holding and waiting.
And as it turns out, that can be just as effective.
All of the research shows that active investing doesn't outperform passive investing. Even if one fund manager outperforms in 1 year, their likelihood that that same fund manager will outperform in the next year is just 20%. And the likelihood that that fund manager will outperform in the following year after that is just 10%.
So passive investing can be a great, boring alternative strategy for investors who aren't into picking stocks or paying active fund managers. Well then, let's dig in deeper into the index fund, that specific, boring investment that Warren Buffett put his money on, and into the intentions of the man who first introduced it.
Jack Bogle, as the founder of Vanguard, was really an icon. I had the opportunity to meet him several times because I've been at Vanguard since 1997. It was right around the time that he actually retired from Vanguard, but he maintained an office there all the way up until he died a few years ago. From 1970s all the way through the 2010s, he was telling the same story, but telling it in 100 different ways, which was that the financial services industry had an obligation to do better for investors. He was singly focused on how does he help investors to improve outcomes. And he thought about doing that through lowering cost and lowering complexity. There's an incentive for the industry to make it complex because if something's complex, you can charge more for it. And so if we can reduce cost and complexity for investors, it's going to give them a better chance of investment success.
In 1975, those principles were foundational in the introduction of a new way of investing, indexing.
Jack was fond of saying that you could pay somebody a lot of money to go find the needle in the haystack, but why not just buy the whole haystack? And really, that's what indexing is. It's buying the entire stock market and getting the return of the entire stock market at a much lower cost than what you would do if you were trying to find somebody who's going to pick the stocks within the haystack and charge you more for it.
Most people are in there for speculating, for gambling, and for trying to beat everybody else in the next day or in the next week. That's a recipe for disaster, and that's a recipe for high risk as well. For me, I'm in the markets to benefit from the global economic growth over many, many years. And we know that the stock market has grown by 7-8% over the last 100 years in a very, very regular manner on the long game. And I'm in the market to take part in that.
So with an index fund, we're basically following the long-term growth of the market as a whole. And as a passive investor, the long term is what it's all about.
De reden om niet te beginnen elke keer was dat ik dacht, nou, ik ben eigenlijk al te laat. Weet je wel, dat heeft helemaal geen zin. En Pim zei tegen mij, je kan nog beter vandaag beginnen dan morgen. Want uiteindelijk heb je het meest aan de lange horizon. Hoe langer je belegt, hoe meer het je gaat opleveren en hoe beter dat eigenlijk is. En dat heeft te maken met het rente-op-rente effect, wat Pim ook wel het 8e wereldwonder noemt. En toen hij me dat uitlegde, toen dacht ik ook wel, oh, zit dat zo? Ja, oké, dan gaan we beginnen.
Compound interest, dat was voor mij eigenlijk de grootste ontdekking als het gaat om beleggen. Ik merk heel vaak vragen aan mensen aan mij, moet ik nou beleggen? Dan heb ik het vaak helemaal niet over beleggen. Ik leg altijd compound interest uit. Want ik denk, als je dat snapt, dan is het een soort van no-brainer dat je vermogensopbouw gaat doen.
Compound interest basically means interest on interest, a principle that will make an initial sum of money grow exponentially over time. What it also means is that the most gains are made towards the end of any given period we put money away for.
Imagine that you're looking at a lily pond. Somebody has just put one lily into the pond. Lilies double in size every day. And what you know is that it will take 30 days for the lily pond to become completely covered. You ask yourself, well, on what day will the lily pond be exactly half covered? So the answer is 29.
Okay, now let's translate that to investing. If a person puts some money away and adds small amounts to it monthly, even at a modest average rate of return, that money will grow exponentially over the long term, with the most impressive gains in the latter stage of any given period. The magic of compound interest is also at work when you invest in index funds, or in their modern counterparts, exchange-traded funds, known as ETFs. And if you can keep costs low, for example with index funds or low transaction costs, That makes a big difference over the long run.
The fact is, what Jack saw through was that the active fund industry was relying on star managers and kind of marketing hype to build up funds that may beat the market, but may not. And importantly, probably charged more than they really should have.
And one of the people that happened to agree with this way of seeing things was willing to bet $1 million on it.
As expected, Warren Buffett won the bet.
The world's richest man just won a 10-year wager that he had with a top hedge fund manager.
So if the most successful investor in the world won this bet by going the passive route, does it mean that the passive approach is always better? Not at all. If you are willing to spend a lot of time on it and have quite some investing knowledge, sure, active investing might be a reasonable option for you. But if you don't want to worry about it all that much and you're investing for the long term, passive can be the smarter option.
Find an index fund, diversify across asset classes, and put your money to work that way. That also allows you to just spend time where it really matters, with your family, with your loved ones, instead of trying to think about, well, what is my fund doing every day and every second? But the critical question is that we have to begin somewhere, whether it's $50 or 50 euros, to start investing in a way that will get you to that long-term wealth.
We've seen that we can invest actively or passively. Either way, it might seem jarring to start putting our hard-earned money into the stock market. Investing does come with a risk, but we can manage the amount of risk we take if we apply our second investing basic.
Diversification is a really important concept for investors. And the easiest way to explain diversification is through an analogy, the advice being, don't put all your eggs in one basket.
To see this principle at work, let's have a look at how the largest sovereign wealth fund in the world chose to move from a single source of income to diversifying its investments globally. This true story starts in the late 1950s, when an important decision was made by the Norwegian government about the international prospectors that came looking for oil and gas in its territorial seas.
In 1963, a law was passed in the parliament stating that any resources found on the continental shelf should belong to the Norwegian states. So that was probably the most important decision in this whole story.
A decision based on Norway's history with natural resources.
And there was also a concession law for waterfalls with the same philosophy. These resources should belong to the state. So there was a tradition in Norway to try to secure such possessions for the future generations. Oil was detected late 1960s. The day before Christmas Eve in 1969, they got the final telephone call that, well, we have struck oil. In 1974, the government passed a bill to the parliament stating that the oil and gas resources belongs to the Norwegian people and it should be managed by the parliament on behalf of the people.
And in order to manage the wealth that was being generated by the oil and gas revenues, an investment fund was set up, the Norwegian Sovereign Wealth Fund, which now manages over $1 trillion, including pensions for all Norwegians, making it by far the biggest sovereign investment fund in the world. It's clearly important to manage resources responsibly, but let's scale it down a bit. Let's take a good look at how we manage our own money and start with our savings.
The first thing is making sure that people have an emergency savings account. And I think the word emergency is such an odd word because it feels like it's this odd event that's never gonna happen, it's 1 in a million chance. But what we know is that oftentimes consumers face 3 to 4 emergencies in 1 year. Your car is going to break down. You are going to need a little bit extra cash. There might be a house repair that you have to pay. We have unexpected expenses come up all the time, so much so that these unexpected expenses need to become expected. After you have a savings account that you feel really good about and can cover roughly 3 months of your expenses, the next step is to figure out what is your long-term investment plan look like for your retirement. Most of us are not excited about the idea of working when we're 70 or 80 years old, right? That's not part of the plan. And so we need to make sure that we're set up for retirement.
So managing our money is all about looking ahead.
I think also it was important to see what we can do in managing this wealth in order not for the present generation but also for future generations. So it was a very broad consensus in the parliament and in politics that one should look forward, not only for today but also for the challenges of tomorrow.
Our goal is to try to help someone become as financially capable as possible, given the tools that we have. And we know that one of the best ways to do that is to invest in the stock market. You're not going to be able to get the same returns as you would if you were just to leave your money in a savings account. It's the one tool that we all have access to in order to increase our wealth.
So then, if we choose to invest in the stock market, we have to realize we're exposing ourselves to a certain degree of risk.
The stock market is volatile. It's not guaranteed returns, right? And we're talking about this as a way to build wealth, which most likely it will and it has done for the past few decades, but it's not guaranteed. And I want people to remember that this is a sort of icing on the cake.
Understand that investing is a roller coaster. When you are aggressive as an investor, what that means is that your roller coaster is going to have a lot of ups and downs, and they are going to be steep downs as well as rises up that really feel exhilarating. But you can't just have the ups, you have to experience the downs too. We're sort of teaching about sensible investing as opposed to investing to deal with psychological needs that are deeper, is think of yourself as a long-term passive investor and then go for the balance point where you can sleep well at night as you let your portfolio do what it's going to do and as your wealth rides the roller coaster. And it's the roller coaster that should feel comfortable for you so that you don't damage your emotional health and your mental health by trying to get rich too quickly. But if you have a long enough horizon, the odds are very good that if you invest sensibly, you'll do just fine in the long term.
And diversifying is a key factor in sensible investing, just like it was done in Norway.
The main idea is quite simple. You have a natural resource, oil and gas, and you cannot be dependent on only the revenue from that oil and gas. So what we have been doing is shifting assets from one source to 9,000 different sources with stakes in the global economy and in global companies. So it was diversification of risk and to mitigate risk, really.
Kijk, spreiden is, ze noemen dat in de financiële sector ook wel de only free lunch that you get. Het is gewoon de makkelijkste manier om je risico te verlagen door te spreiden. En spreiden kan je eigenlijk in allerlei vormen doen. Dus bijvoorbeeld verschillende landen, verschillende sectoren, verschillende industrieën, verschillende valuta. Eventueel nog verschillende effectentypes zoals obligaties en aandelen. Eventueel misschien nog zelfs met fysiek vastgoed.
So if you hold in your basket a group of stocks, what you would like to have happen, if you apply the same diversification principle, is that they're sufficiently different from each other so that if something bad happens with some of those stocks and they underperform, you'll still get favorable returns on average from the other stocks in your portfolio, and so you'll be protected.
Okay, let's take a closer look at this. So, for example, we hear a lot about the tech sector, which is very popular for investors, but there are numerous other sectors out there.
Energy is different from health. If there's some bad news for the energy industry, there's no reason to think that you'll also have that same bad news carrying over and being problematic for stocks in the health industry. That's the notion that we have. We look for variety. Diversification is variety.
The same goes for the geographical space. Some of the most well-known stock markets are in the US and in Europe, but they're not the only options you can consider. And diversification over time, over the long run, it's always better to be in the market than out of it. But if you're worried about what the right timing is to get in, put money into your investments at regular intervals. That way, you're never too late or too early when the market takes big swings upwards or downwards.
By all, the management of the oil wealth has been quite successful in Norway. If you look at the fund today, less than 50% of the fund is collected money from the revenues, and more than 50% is return and increased value through the management.
Managing our own money in a well-diversified investment portfolio has become increasingly easy over the years, as developments in the stock market have made it increasingly accessible.
Ik denk dat het veel makkelijker is om te gaan beginnen met beleggen nu dan als je het zou vergelijken met bijvoorbeeld 30 jaar geleden, omdat informatie gewoon veel toegankelijker is.
Ja, en daar nog denk ik nog aan toevoegend is dat de innovatie in de beleggingswereld is ook doorgegaan. Dat je vroeger misschien met minimale starttarieven van 10.000, 100.000 euro moest denken om ook de transactiekosten een beetje te drukken. En dat heel erg handwerk was, want er stond iemand op de beurs. Dus je ging eerst naar je agent toe. En die moest weer iemand bellen en dan moest iemand zijn hand opsteken en zo werd het verhandeld. Dus het was een heel arbeidsintensief proces. En daarnaast hebben we denk ik ook nog de innovatie van een ETF. Ik vind dat eigenlijk misschien wel een van de grootste innovaties in de beleggingswereld. Misschien wel een beetje de emancipatie van de retailbelegger, denk ik. Omdat je daardoor met een heel laag bedrag in één keer goed gespreid kan zitten. Dus een laag bedrag, weinig risico. En dat is denk ik een hele grote innovatie voor jonge mensen om te starten met beleggen.
I have certainly a very fundamental strategy also with ETFs, because that's the best way. You just get a global exposure. You win some, you lose some. You get a really vast exposure to many companies, and therefore reduce your risk because you're very diversified.
Dat hele beleggen, dat was altijd een spelletje voor rijke mensen. En ik wou er ook eigenlijk om die reden gewoon niet aan meedoen. Ik vond het ook een beetje vies. Aan de andere kant, ik vind dit juist door de ETF's en doordat het zo makkelijk is geworden, het is eigenlijk een hele mooie democratisering van de particuliere belegger. We kunnen nu allemaal meedoen en het is helemaal niet zo moeilijk. En we worden niet langer buitengesloten. En dat vind ik wel heel mooi aan ook eigenlijk. En dat maakt het ook leuk. Dat maakt het soort van, daar gaan we.
Investing is more accessible for us than ever, and tools like ETFs can make diversification quite easy. But if we decide to venture into this exciting world, it's important to limit the amount of risk we expose ourselves to by having a game plan. It's just as important to stick to it and not get caught up in exciting hypes or worrying news. How do we remain calm in these situations? Well, let's look at our third basic principle and a true story of one of the biggest stock market hypes from not so long ago, the dot-com bubble of the 1990s and the crash that followed.
Well, the late 90s was an incredibly exciting time if you were an entrepreneur, an investor, or actually a journalist watching what was going on.
And they've grown very rapidly in the last couple of years on the back of the success of a game called Lemmings.
There was a huge buzz in the air. There was a certain unreal feeling to it, but there was an idea that anyone with a smart idea could start a business and possibly become very rich indeed in a very short amount of time.
It's living the American dream.
If you sort of look back over my shoulder, it was all happening in this area. The 1990s was a time when most investors looked around and saw a revolution, an information revolution, a digital revolution. And everything looked like it was changing in terms of e-commerce in particular, electronic commerce, that we would wind up being able to order all kinds of things, not by having to go into stores, but looking at screens. Imagine what an idea that was in the 1990s.
You get whatever it is in the world you want from the World Wide Web. Lycos, go get it.
Same groceries, no store. Web ban. You may never go to the grocery store again.
So suddenly, people saw a market there. They began to understand that you could sell things online. The first online book retailers were born. There was one called, I think, Book Pages or something similar in the UK. And of course, there was a little one called Amazon in the United States.
And with the new companies came new opportunities for investors.
Everything started in 1995 when a company called Netscape...
Next time you're on the internet, go to thenewnetscape.com.
IPO'd in New York. It was the first web browser, or the first effective web browser. The company was a little more than a year old, and its shares went boom lots of other businesses getting revenue in the early stages, their priority was not to balance the books. Their priority was to grow as rapidly as possible, build it and they will come, as it were, and worry later about actually turning a profit.
This is a revolution underway that's affecting the way we do business and live our lives.
And investors bought into this mantra wholeheartedly.
So there's this general sense that it wasn't just tech stocks. The world had changed in terms of the information age. That had changed investors' comfort with investing in stocks of all kinds, not just high-tech stocks, and that was going to lift the market and keep it up permanently.
When you're on top of that wave and you're surfing, you got to ride it to the end.
But in the spring of 2000, the wave broke and stock prices fell across the board.
Traders say this is the craziest day they have ever seen.
It was the worst day on Wall Street.
The dot-com failures continue to mount.
So, as an investor, how do we deal with these kinds of bubbles and the inevitable crashes? Well, let's start by trying to understand the mechanics behind them. For long-term or value investors, a company's stock prices should reflect fundamental values, which are based on data like a company's income, revenue, and cash flow, as well as its competition and growth potential.
When the stock market goes into a period that we call frothy, market values tend to rise above fundamental values. And investors become very enthusiastic. Most investors, including some professionals, really don't take time or make the effort to compute fundamental value. They just know stocks are going up. So they buy more stocks, and that tends to push stocks up even higher. And so stock prices during a bubble rise much faster than what those stocks would be worth to a long-term investor who would be only buying and holding.
These prices continue to rise until they reach a tipping point.
It happens because investors become disillusioned all at once, that the good times are over. And so they bail all at once. The rises are dramatic, but nowhere near dramatic as what happens when the switch gets flicked.
In less than 2 hours, nearly $10 billion invested in stocks was simply wiped out.
Today is Black Monday, the day the Dow dropped more than 500 points. It's around the world, stock markets fell faster than a skydiver without a parachute.
It's a panic. Everyone's in panic.
Lehman Brothers filed for bankruptcy.
This could be the most serious recession in decades.
What drives investors, even the professionals, to behave in this irrational way?
There are really interesting dynamics at work when we have bubbles and crashes. So usually the beginning of a bubble, stock market bubble, involves a sense of euphoria. Usually it means that there are dopamine flows that have increased and are channeling through some investors' reward centers in their brain. That induces them to become excessively optimistic about the future. And that typically means that they underweight the likelihood that there'll be bad news coming, and they attach too high a weight to the fact that there'll be more good news coming down the road.
So it can be our psychology trying to get the better of us.
We have greed within us. So we all want to make 10% in the next 2 weeks. But I really try and hold myself back and not fall into that pattern at all, and really try and stay realistic. Anyone who promises you like 15, 20% per year, careful, because that's all, there's going to be high risk in that.
The very nature of a bubble is that people kind of lose touch with reality. There is that classic phenomenon, FOMO, fear of missing out. You hear that your mate has just bought some shares in a company and doubled his money in a matter of months, and you want some of that too. You don't listen to your other mate who's lost money. You hear only good news.
That last part is what in behavioral economics they call a cognitive bias.
So we like information that confirms a view that we hold, especially if it's a view we want to hold. And we don't like information that is disconfirming, that goes against the view we hold, especially if it's a view we want to hold. So we call this particular psychological tendency confirmation bias.
And that's not the only bias to look out for.
So extrapolation bias is the tendency to look at what has been and ask yourself, if that pattern persists, the one I've just spotted, and I extrapolate it into the future, what will the future look like if the future is an extension of the past? And sometimes it will give you a decent prediction, but it will also set you up for a massive failure if you've been lucky rather than smart.
After the dot-com crash, for the companies that survived, it took some time for stock prices to recover. Hypes can work both ways, meaning after a crash, companies can also be undervalued.
The stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way. You know, a financial bust like the internet bubble bursting is, makes it really hard to raise money, but we already had the money we needed.
I have a 5-year horizon, and I really fixed myself on that. So I have no problem at all in staying calm in the short term. And on the contrary, actually, I'm always happy for opportunities where there's panic out there, because those are the opportunities where I will really try and commit and invest more.
If we think about what happened with the market, though, overall, I think there's a quote which I believe comes from Warren Buffett, which is that in the short term, the market is a voting machine, and in the long term, it's a weighing machine. And I think that kind of sums it up. In the short term, people are kind of voting with their hearts, their emotions. In the long term, the market's a weighing machine. In other words, it eventually decides on the basis of the fundamentals of a business what it's worth.
So let's also zoom out for a second and put these panics and crashes into perspective. We're used to seeing this, pretty scary. When we look at the bigger picture though, something interesting happens. Over the long run, those big crises just look like bumps on the ride. So do we have to ignore those dopamine flows completely?
I like to tell my students about a concept called fun money. We want to understand that some people invest because they're sensation seekers, because they're looking for thrills. Some people climb mountains, others hold speculative stocks. There's nothing inherently wrong with that if you're careful about doing it. But on average, if you invest for fun, invest money you can afford to lose. And keep that money separate from the money you put away to invest for your long-term welfare. And maybe you'll be even lucky, because when you invest for fun, you might actually wind up generating a high return out of it.
Growing your wealth over the long or short term, managing risk and staying calm during crises. That's what investing is all about, right? Well, not necessarily. There's another factor to consider, and it's starting to get more and more attention. How do our investments impact the world? As it turns out, we can actually use investing to change the world for the better in many different ways and areas. Let's consider the true story of how a group of investors managed to use their power as shareholders to impact the policy of several big oil companies and put them on a greener course.
Follow This is a movement of green shareholders in big oil. So this sounds very counterintuitive, but we are convinced that we need big oil to speed up the energy transition, to make any chance to stop climate change.
Dutch activist Mark van Baal wanted oil companies to change their policies, so he came up with an out-of-the-box idea. He bought shares in one of the biggest oil companies in the world, Shell, and became a so-called activist investor.
The goal is that shareholders support and, if needed, force big oil to commit to the Paris Climate Agreement and shift their investments from looking for more oil and gas to looking for new business models in renewable energy.
So buy into the company and kind of influence them from within.
Yeah, we prefer to be called green shareholders. We just have a fair ask, but in practice we are called activist shareholders because we really want to change companies for good. So the most important thing that happened in the last couple of years is that oil companies, one by one, accept responsibility for the emissions of their products. And that's a really big thing, because before Follow This started, they didn't want to talk about that. They said, we're going to drive down our own emissions, but what our customers do with our products, that's not our responsibility. So if they keep on asking for oil and gas, we will keep on supplying oil and gas. And because shareholders started to vote for our climate resolution, which asked them to drive down emissions, not only of their operations, but also of their products, they said, okay, we're going to drive down also the emissions of our products. And that's really crossing the Rubicon, because then suddenly you have something to talk about.
Exxon shareholders elected 2 members of climate-focused investor group to serve on the company's board. Over 60% of Chevron shareholders voted in favor of a petition making Chevron responsible not just for their own emissions, but the emissions of the products they sell to customers as well.
So impact investing is about investors using their voice to make an impact towards a better world. The amount of shares owned by an individual investor is usually not enough to actually affect a company's policy. But if enough shareholders band together, they can make their voices heard, like Follow This. But shareholder activism is not the only way to make an impact with investing, because we have to remember, when we own stock of a particular company, we own a share of that company. And so, if you're an active investor, you can avoid the companies whose policies you don't support by not owning their stocks, or by simply targeting and buying the ones whose policies you do support.
We are at the Green Tech Festival in Berlin, and it's an event that I co-founded 3 years ago. I'm an early stage investor in Formula E, and the Formula E race here in Berlin, I was visiting the race, and I was like, it's such a pity that we don't create a green consumer electronics show around the racetrack. Green Tech Festival stands for impact, and we want to generate impact by creating this global platform to unite the leading change makers in the world and also the leading green technologies, and really create awareness, create partnerships, just accelerate the positive change. There's so many examples. One thing is vertical farming. Indoors, it's called Agrilution. Another one would be Rimac, which is the world's fastest electric car. And they're here, and they just broke all the records. Mobility is one of our pillars. And so we also have the flying taxis. And I'm actually an investor as well in Volocopter and Lilium.
It can be hard to discover which companies are sustainable and how sustainable they really are, especially if you realize that impact investing doesn't only mean green investing.
So there's a new term in finance with 3 letters. It's an acronym, ESG. E stands for environmental, S stands for social, and G stands for governance.
When it comes to the E of environmental, we think about managing resources like water and energy, but also emissions, innovation, and treatment of animals. When we consider the S of social, we think about the workforce, human rights, contributions to communities, and product responsibility. If we look at the G of governance, it's all about how companies are run. It's about company management transparency, shareholder interests, or corporate social responsibility.
Je kan ook bedrijven gaan uitsluiten. Gewoon dat je zegt, nou, in mijn ideale toekomst is in ieder geval geen plek voor dit bedrijf. En dan gewoon niet daarin gaan beleggen. Je kan ook gewoon op die manier proberen een beetje duurzamer te gaan beleggen.
Nou, de meeste ETF's die doen dat ook op deze manier. Die doen gewoon uitsluiting. Een ETF zonder en met is geen.
One of the most popular topics in investing right now is ESG. Investors like BlackRock, one of the largest investors in the world, has taken a note of that. And so they've done amazing things. They put pressure on companies to say, listen, your industry is one of the biggest pollutants across the world. What is your ESG plan? On top of that, they also increase access so that everyday consumers can invest in ETFs or index funds on environmentally sustainable companies.
And there's a lot of ETFs that have grouped together some of the most interesting established companies who are really part of this green revolution. And those ETFs have been performing extremely well.
Due to the rise of impact investing, we've seen a growth in popularity in ETFs that focus on ESG ratings. It's become an incentive for companies to do better when it comes to ESG. Being included in these popular ETFs means more demand for their stock, which means higher stock prices. But there's still room for improvement.
But what I think is sort of missing from all of this and in the discourse is that we focused on this term ESG and only focused on the E. And don't get me wrong, I love that we're moving towards a greener, more sustainable planet, of course. But there's also the S in ESG, which is what are we doing towards social justice?
We've also become aware that it's important to understand that unless you carefully watch managers, that you have boards of directors that provide really good oversight, that companies might not be as well run as they could. So we want companies with strong boards that serve the interests of the underlying shareholders in particular, and other constituencies if possible.
Of course, you're wondering, does investing in ESG actually pay off? Or does investing in what you believe in mean you have to sacrifice on possible financial returns? If we look at ETFs and compare ESG funds with standard funds, we barely see any difference in performance. This might be the reason why we've seen such a big increase in ESG-related ETFs in the past years, as well as the amount of money being invested in ESG-focused funds. Impact investing is paying off.
We want to show how sustainability now is also becoming very, very cool, and it's not anymore a requirement to compromise, to be more sustainable. But actually the more sustainable solution is cooler, more efficient, sometimes even by now cheaper.
Volgens mij zijn er zelfs de laatste jaren zelfs ETF's die duurzaam zijn, die presteren trouwens beter. Dus ik denk dat we die fase wel gepasseerd zijn, dat duurzaamheid meer een soort van charity-idee heeft dan dat. En ik denk dat we dat wel los kunnen laten.
I think we can wrap up our entire conversation with a quote from Maya Angelou that I just absolutely love. She says, "Do the best you can until you know better. But when you know better, do better."
Contributing is a human need for us all. And so for me, I can feel how in this path of investing and in this path of entrepreneurship, where I'm really starting to contribute more and more, I can feel proud, and you feel fulfilled, and that brings happiness not only for others that hopefully we're improving their lives day to day, but also for myself, so that's wonderful.
For me, impact investing means that you try to influence companies and preferably the whole world in a positive way with your investment. I think every investor should be an impact investor.
So, as we've seen, there are a lot of misconceptions about investing. But as it turns out, investing is not only for the happy few. We can all be smart investors, as long as we remember the basics. Do we aim to beat the market, or are we ready to take it slow and steady? Make a plan, keep an eye on the future, and understand how to spread risk. And stick to it, staying calm and patient, even in times of crisis. Last but not least, a smart investor knows that investing can be about our values as well, about having a positive impact and changing the world for the better.